that is required by law to be a fiduciary, which means that we place our clients' interests before our own, and that we also provide expertise sufficient to handle the projects that the clients assign us to. If you listen very carefully, not all municipal advisors adhere to the fiduciary-focused approach. Some actually are, if you listen closely, are trying to push into a transaction. That is not our objective today. Our objective is to make sure that information is shared, all questions are answered, so that the decision makers, city council, understands the concepts behind what a pension restructuring is. That is our sole objective today, and that's what we're going to jump into right now. Next page. So the background is the city, like most Calpers cities in the state of California, has a very large pension liability with Calpers. In fact, it's the largest liability on the balance sheet. The liability consists of the unfunded accrued liability, the UAL, with Calpers, plus there's a remaining balance on the pension obligation bond that the city issued in 2007. Those two total the $27.7 million liability on the balance sheet. We're going to speak primarily to the $24.9, approximately $25 million unfunded liability that is with Calpers. This liability has increased significantly over the last 5, 7, and 8 years, from about $12.3 million to $24.9 million right now. That's the last statement balance. Calpers charges 7% on that outstanding balance. These, you're not alone. All cities and other public agencies have been seeing this rapid increase for a variety of reasons that we'll get into. That along with that rapid increase in the unfunded liability is a rapid increase in the repayment schedule, and it's an odd repayment schedule with Calpers because it's almost like an onion. Every year they layer on an additional amount if they don't make their investment earnings, or they change their assumptions like mortality rates and such, or they lower discount rates. So you'll see in a moment that the repayment schedule has gone up, and it's gone up in an irregular fashion. So with this liability and this payment increase, this creates really a need to discuss and evaluate your Calpers pension funding plan with the full array of options reviewed. And we'll get into that a little bit in order to create a long-term fiscal sustainability confidence factor. The past and future cost management strategies should be well understood as part of this discussion, and we'll get into that. There's annual UAL prepayment, the ADPs that the city's been doing, cost sharing, which has been done. More and more of the employees are going to the new plans from the classic plans, the PEPRA plans. We'll talk about the Section 115, which the city has, the ADPs the city's been doing, which is an additional discretionary payment that you make every year. And then, of course, the focus of this presentation will be about restructuring the unfunded liability using debt. Next page. So the city has two primary plans, the miscellaneous, which you have 133 covered members, retired and active, and your safety, police and fire, 104 covered members. The lower cost benefit PEPRA plans are helpful. In the long run, those will help manage and mitigate the unfunded liability figure that you have on your balance sheet, because those benefits are less. So there is some unfunded liability with the PEPRA plans and the employees that are within the PEPRA plans, but that amount of unfunded liability is negligible compared to the unfunded liability associated with the classic plans, retired and active. So about 99% of the unfunded liability associated with the classic plans is on the city's balance sheet, on your books, and it will remain there. It's been going up, and it will continue to go up based on assumptions that we believe to be accurate. Next page. So, this is Calpers 101. How do you have an unfunded liability? Well, really, it's, you have an account with Calpers, and the actuaries determine how much money you need on account with Calpers in today's dollars to make the payments over the next 30, 40 years based on mortality rates and pay scales and such, to pay those payments to your retirees over the next 30 to 40 years. That number is approximately $85 million. And then you just simply take how many monies that you have on account with Calpers, the assets you have in your City of Oroville account with Calpers. That number is $60 million. And that produces a deficit of $25 million. That ties to the number we showed up on the previous page. That is your unfunded liability with Calpers that you have on your balance sheet. Next page. Mike, I'm going to let you handle this page. I'm going to get something to drink for a second. Okay?
No problem. And good morning, council members. Mike Meyer with NHA Advisors. So on slide 7, this is the repayment schedule at this point in time for the city's unfunded liability. Those payments on the $25 million unfunded liability are shown in blue there. So those blue bars are a combination of paying back that principal of that $25 million of debt, also at 7% interest rate. What we've also shown here in the gray bars are the outstanding 2007 pension obligation bonds that the city has as well outstanding. So you can see overall pension payments have grown from a little under 1 million in 2015 to currently about 2.5 million for 21, scheduled to peak in a couple of years in 2023 before a little bit of a drop off, and then increasing again up through 2032. And then you start to see that payments fall away. As Eric mentioned, what's driving this is the fact that, this debt, this $25 million debt, it's not just one loan like a home mortgage that's over one term. It's actually a combination of 20 different, let's call them mortgages. They all have different terms. So some of them have 4 years remaining, some have 8, some have 15. And when you aggregate them all together, you get this irregular payment pattern here. Any questions on this slide? Okay, I'm going to flip to slide 8. As Eric mentioned, unfunded liabilities have been growing for all California agencies over the last 10 years. Unfunded liabilities were not really a problem 20 years ago. Most of that was due to the fact that PERS was earning 10% in the stock market at that time. So the earnings were more than adequate to cover retirement costs. However, over the last 20 years, we've seen more sluggish investment growth. The 20-year average right now is at a 5.5%. Combined with that, Calpers has made assumption changes at various points in time, and the biggest one is their discount rate. A discount rate is what their assumed earnings rate is going to be, and every time they ratchet that down, that immediately drives up the unfunded liabilities for California agencies. And they first brought this number down in 2003 from an 8.25 to 7.75. They brought it down to 750 in 2013, And then just last fiscal year, it was brought down to 7%, which is one of the driving factors behind the recent increases. We will get to this in a few slides, but in positive news, Calpers is having a very good year this year. They're at 20% earnings at this point in time. So that will bring down the city's unfunded liability, and we'll get into that in a few slides. However, we have heard some rumblings that Calpers may ratchet that discount rate down again this year, given that it is a good year, because those things will offset in a way. The other, as we look down on the bottom right in the third main blue bullet, the other challenge is that every time there is a new unfunded liability payment layer that gets added on, the city is forced to repay this over 20 years. So this is a shorter period than it used to be. Calpers used to historically layer these payments on over a 30-year period, which meant that the annual payment was a bit lower. You had more time to kind of catch up to that annual payment, but the shorter schedules mean higher annual payments. So turning to slide 9, before we get into the restructuring concept that Eric mentioned earlier, we wanted to make sure to lay out all of the primary options for managing costs that most agencies are using. Many of these are tools that the city of Oroville has already been using as well in the recent past. The first one, fairly low-hanging fruit, but this is if you're in a position in July of each year, in the beginning of the fiscal year, to pay all of your UAL for the entire year up front, Calpers does give you a 3.4% discount, and I believe the city of Oroville has been doing that historically. The second tool in the toolkit is obviously negotiating cost sharing with employees to make sure that everyone's paying their fair share. City of Oroville has already completed that as well. The third option is what's known as a fresh start amortization with Calpers. This essentially changes that irregular payment pattern into more of a linear repayment pattern. What Calpers requires, though, is that you have to shorten the term of the payments. So that means when agencies execute a fresh start, most of the time it's over a 10 or 15-year period. This means that you do pay off that debt sooner than you otherwise would have, but it does mean that your annual payments are higher immediately, which that's one of the reasons this is not a popular option. Most agencies don't really have the capacity or the desire to pay more in the near term than they're currently paying. The other downside of this strategy is the fact that once you execute a fresh start, Calpers will not allow you to go back to your previous schedule. So if you needed some relief, you couldn't go back to your old schedule where you had lower payments. So because of this lack of flexibility, this is not a popular option. There are other ways to essentially effectuate the same benefits using the fourth option here in the toolkit, using cash to pay extra. And there's two primary ways of doing this, and the city has actually executed on both of these strategies in the recent past. The first is to set up a separate account, what's called a Section 115 trust. Once those monies are deposited in that trust, they legally must be used for pension or OPEB expenses, but it is a way to take some of that general fund cash, which is, you're very restricted in what you can invest in with that money. Getting it into the 115 trust does open the door to more options. So, you can invest aggressively, similar to Calpers. You can invest conservatively, perhaps in fixed income, but it does give you there's a long menu of options in how the city can invest. I think this number here that we have of 3.3 million has grown quite a bit this year because similar to Calpers, the city's Section 115 trust investments have also grown in a healthy manner. So I believe that number is closer to 4 million at this point. The second strategy is to use cash to actually just send that money to Calpers. You can tell Calpers which layer of that UAL debt you want to pay off, and you get the benefit of saving on that 7% interest rate. That is something that the city has done in the last couple of years, making $1 million additional discretionary payments to Calpers. The fifth option, and really the option that we're going to discuss in more detail for the rest of the presentation, is restructuring that debt. So essentially converting the 7% Calpers debt, or some of that debt, not all of it, to lower interest rate debt through a UAL restructuring pension bond. As Eric mentioned, interest rates have ranged from 2.5% to 4% for other agencies who have executed on these pension bonds in the last 12 to 15 months or so.
May I ask a question real quick before you leave that slide,
Please.
Mike?
Of course, yes.
Mike, this is Dave Pittman, Councilman. When you mentioned the Section 115 trust, in that trust rules and regulations, are we bound by the state of California's policies on investment policy, or are the investment procedures wide open? As one of the problems I understand is the state legislature has restricted PERS investment objects, what they can invest in. Do we have the same restrictions in the Section 115 trust?
I believe you're with PARS, correct, Ruth? So I think the answer is no, but you'd have to double check. I think the city, by the fact that it owns that account, is not the only folks that would potentially have the ability to put restrictions on that account through PARS would be city council, I believe. But I may be speaking out of turn.
I also believe it's no, and we have our choice to be conservative, moderate, or be a little risky with it. The council has chosen to be conservative with it.
Okay, thank you. I appreciate that. I just wanted that info on the Section 115. Thank you.
Eric, would you like me to continue on 10?
I got you rolling. Keep going.
Okay. So slide 10 here, just a quick high-level overview of the restructuring concept. This is a strategy where an agency issues debt, a bond to investors, or a loan with a bank, and uses those proceeds to pay off a portion of the UAL debt with Calpers. Typically, the vehicle used for this is a pension obligation bond. This is an unsecured debt, so it means that there's no collateral required by the city. There is a court validation process that's required that takes several months that is needed to confirm that the UAL is truly a debt that can be refinanced. City of Oroville is one of many cities that has issued pension bonds in the past, so we believe we have not had any sort of legal counsel review the old documents, but we did do a quick review, and we do not believe a new validation process would be necessary if the city of Oroville ever wanted to evaluate doing another pension bond. The alternative option that some cities have turned to over the last couple of years is a lease revenue bond, where certain assets are used to secure that debt, be it city-owned buildings or parks or streets and roads, things of that nature. There's some pros and cons of each structure, but the strategy is really the same, which is to convert that 7% debt to something lower, and also, as we'll get into, kind of have a clean slate to reshape the payments in a way that works best for that agency. So some agencies have done a 15 or 20-year financing. Some have stretched it out over 30 years. Many have created a very tailored repayment shape to meet different objectives and constraints, based on their general fund forecast. So that flexibility is really the second reason, in addition to the lower interest rates, that some agencies have turned to this strategy. And as we're going to focus in on a lot today or this morning, is really the risks as well. There is what's known as reinvestment and market timing risk that are related to any sort of UAL restructuring where you give Calpers, a lump sum of money at one point in time, because you are exposed a little bit more to those Calpers returns. And so we'll talk a little bit more about what that means, and also what the process could look like to really quantify those risks. What we call a stress testing process, which is something we highly recommend is incorporated if when our clients evaluate this strategy in more detail. So just quickly about the pension bond market, there's been about 45 to 50 agencies in the last year or so that have issued UAL restructuring bonds, about 5 to 6 billion in UAL that's been funded. And those interest rates have varied quite a lot. I think on the low side was City of Chula Vista that we worked with earlier this year. They secured a 2.54% rate for a 25-year transaction. On the higher side, a little over 4%. But big picture, rates have trended down over the last year or so, even though taxable treasury rates, government bonds have trended upwards a little bit in the last few months given inflationary concerns. But what we've seen is that there's a lot of investor demand for these bonds. So those rates have really come down 50 to 100 basis points, so a full point over the last year or so. Most of the agencies who went to market last spring were in that 3.5 to 4.2% range. In 2021, as you can see from the left side of slide 11, 9 of the last 10 cities that have come to market have been below the 3% interest rate. And you can see a lot of those agencies listed on the top row up there with the city logos. So we wanted to throw a graphic out that really just shows what the strategy is.
You're on now.
Oh, I'm sorry. Mike, go back to the last slide. I just want to make sure that one point is made plain. What you usually always mention, and it relates to the interest rates are dependent upon the length of term and the credit of the agency selling the bonds. So you can see some A+. There's a lot of AA level credit, AA minus. You see several A+ in there as well. So that's an important factor to secure the rates. I think Chula Vista was a AA, very solid rating. So they're at 2.54, and they hit the market just right.
I have a question.
Yes, sir.
Wait a minute, we're in the queue with Councilmember Riggs. I'm sorry, Councilmember Smith.
Thank you. I was just curious on if we know what kind of rating we are at or what we might expect to have for this.
Great question. We haven't run the scorecard on the city. From what we're hearing from Ruth, the general fund is looking very, very strong these days. So that's a plus. Structural positives. All of your reserves or buckets are being filled up very well. You're addressing a lot of these issues, pension, however you do it, you've got good policies in place. The offset to that is usually Standard & Poor's looks at economic factors, and they match that to national levels. So that would probably be an offset. I don't know. I think A+, AA minus area is a likelihood.
Thank you.
But don't hold me to it. But I think that's probably.
Councilmember Smith.
Yeah, thank you. So when would we get the rate lock let's say just hypothetically, we decided we were going to go through with this. You said it takes several months process.
Correct.
So is that once that approval happens, is that when the rate lock happens?
If you do a public offering bond, a municipal bond issue where you go and sell these bonds to investors, you don't have that rate locked until the day that you sell the bonds to investors, and that the underwriter then makes an offer to the city that they will underwrite the deal at those rates. So unless and until you get to that bond sale date and you have a bond purchase contract that the city manager, city administrator would execute on behalf of the city, that's the day that you actually lock it for these types of transactions.
So with that being said, the market's become, speculation is, and this is all speculation anyway, that the market's going to become more volatile, interest rates are going to begin to climb. Let's say we decide we're going to do this based on a certain rate that looks very, advantageous, but then we get down the line here in 2-3 months out, and things have completely blown up, and now the rates have, gone up to a point where this is untenable. We just don't think this makes sense anymore. Could we then retract it? Could the city council then say, "Whoa, hold the phone, Charlie"?
Well, first of all, you can set parameters for acceptable terms for the city, so that when you give the city administrator the authority to sign a bond purchase agreement, that anything beyond the parameters set would not be acceptable. So, but the point of your question is the city is not locked into a transaction until a bond purchase contract is signed on the date of the bond sale. So if the market goes up and, everything just falls apart, it's clear that the objectives, this is all hypothetical
Sure,
here.
absolutely.
If the city's objectives had been set and not being met for what is in the market at the time that you get there, then you pull it.
Very good, thank you.
Okay, go ahead, Mike.
Okay. So flipping to slide 12, we wanted to run a few hypothetical scenarios just to allow the city to get a sense of what a restructuring strategy for smoothing out payments could look like. And then we'll flip to the next slide after this to look at some of those numbers. And also the sizing. That's a big, I think as we'll get into, this is very much a start. It's a few options. Typically when we go deep in these projects, we could look at dozens and dozens of options, because you do have the ability to pay off a small chunk of the UAL. Some of our clients have paid off 30, 40, 50% of the unfunded liability. Some have gone 100%, and there's different rationale for different sizes. Obviously, the term is also another option you have. So some of our clients have gone out 30 years, some 20, some 25. Some want a smooth, level payment shape, as you can see here with the orange and the navy blue line. Some, like I'm thinking of the city of Ukiah, wanted something that was increasing each year at a 1% level and then declining in the back end, which is why we showed an option here in the green line. But of course, just to start, really you have flexibility to put into place a shape that works best given your specific needs. But just to touch on these three, the orange is a 25-year level payment restructuring. The blue line is a little bit shorter, which is why your annual payments would be higher. So slightly lower interest rate, as you'll see on the next page, but you will have higher annual payments. And then in green, a little bit of a unique shape where you have an increasing structure for the first 15 years, and then it declines in the back end to kind of mimic the current Calpers schedule that you're on, which you can see in the blue bars. The savings estimates are shown here on 13. I do want to make clear that this, when we talk about savings, It is estimated. As we'll get into, actual savings are dependent on future Calpers returns, which of course are unknown at the time of issuance. So typically a kind of a preliminary savings analysis will just make the assumption that Calpers actually hits its mark. As we'll get into, we think it's beneficial to also go through a stress testing process to look at what happens to savings if Calpers misses their mark. So obviously on the high side, if they do better, savings is better, but we like to look at situations where perhaps Calpers only earns 5%, 4%, something lower than the 7% target. Also, looking at a potential scenario where there's a big market downturn immediately. So perhaps another 2008 recession, things like that. I'm jumping ahead a little bit, but I do want to point that out. Based on these estimates, we're looking at present value savings of between 5.3 and 5.9 million under each of these scenarios. You can see moving from left to right, in the middle row there, the all-in interest rate we're assuming is between 3.3 and 3.5%. So this is, I'd say, pretty much in line with the market. It may be slightly high, but we want to be a little bit conservative with these numbers that we're showing you. I think the bottom rows are probably the most important for differentiating some of these different scenarios. So if you're looking at the let's say the shortest option, which is in navy blue on the left, the 20-year, that one generates cash flow savings of about 9.4 million over the next 14 years. So through 2036, that's kind of the challenging period that you're facing with the Calpers schedule. As you go out to a longer financing, the interest rate goes up by about 20 basis points, but because you're able to lower that annual payment, you do maximize savings over the next 14 years. So you can see that number jumps up to closer to 13 million if we're looking at the row second from the bottom. And that's really the trade-off there. And that's something we like to get into deeper as we work through more options. The other part of this that we'll hit on a following page is a word we like to bring up a lot, which is resiliency. It's one thing to look at these numbers and assume Calpers does earn 7%. What we like to do is look at some of the what if situations. So what if Calpers has a couple bad years? What does that do to the city's payments with and without a bond? Because, putting into place a repayment shape that gives you the capacity to absorb those future shocks, we think is very important as well. Obviously, you get a little bit more resiliency as you go out longer with your maturity. The lower you could bring down your annual payments, you have more space to absorb any future economic shocks, and we think that's just as important as just kind of the overall interest rate being paid. Lastly, here on the bottom row, these scenarios generate anywhere between 564,000 to 865,000 a year in average annual savings over the next 14 years. The one thing I want to point out here, we did choose 19 million as the payoff amount. Again, there's no wrong or right answer to the exact sizing. That is another thing we would want to get into in terms of showing all options and talking about the pros and cons. But there was some rationale
Excuse
to
me, sir.
why
Councilmember Pittman has a question. I'm sure.
Yeah. Mike, thank you. Can you back up to the last slide you were talking with the years real quick? That one there.
Yep.
One of the things that I know I'm going to want to ask, so just down the line, what is of the cities that have done this pension obligation bond, what's the average time they have chosen? Just as an information for me, because what I'm looking at is all the other cities that are doing this, basically that's our competitive market. So I would think that my selection, if I were to select one of these 20, 22, or 25 years, I'd want to be very close to what the other cities are doing too. Or maybe you know this off the top of your head, I don't know.
Yeah, and Eric, you might want to chime too, but
Sure.
for the most part, we're seeing that, I'd say that 23 to 25 year range, because that's the same maturity or term that you're currently paying back your UAL. So some cities have gone longer. That's a conversation you have, sometimes when you go to the credit rating agency, extending the term is sometimes looked at with a negative view, although we have not seen anyone, have their credit rating downgraded because of extending. So I'd say for the most part, most folks are in that 2044 to 2045 maturity, which is, 24, 25 years out. But the consistent theme for almost, I'd say 90% of the other agencies is that folks have put into place a more smooth structure. So, that whether it's 23 years or 25 years, it's for the most part, it's always been a fairly level payment shape or something that's growing at 1 or 2% a year.
Yeah, I would just amplify on that last statement, what Mike had just mentioned. Personally, I think the restructuring benefit of the irregular shape that you have now to a smoother shape, a predictable shape for budgeting is, if I had to rank the two benefits, I'd say that is number one. The savings, you wouldn't do it without the savings, so that's number two. And they are attractive right now. This all is predicated upon Calpers earning 7% or at least above the bond rate that you get. And while we're on this slide, I also wanted to make sure that it was clear that the three gray bars there, those are the remaining payments on your 2007 pension obligation bond. And we are assuming that those are not refinanced because the call premium, the optional redemption premium that are on those bonds would be cost prohibitive. So what we're doing is wrapping whatever we do in any kind of option that we show around the outstanding debt, just for information.
Thank you.
So flipping back to slide 14, we in our preliminary analysis, we did choose a payoff amount of 19 million. So a little bit about that rationale. The city's current UAL is 25 million. As I mentioned, Calpers is having a very, very good year this year. We think that the UAL for the city may come down as low as 16 to 17 million just from the benefit of this year's returns. Those returns, I think we talked to an actuary last week at Calpers, are around 20% right now. So that's well above their 7% target. We have heard rumblings, though, that Calpers will kind of take advantage of this good year to ratchet down the discount rate again. We know that long-term they want to be, probably somewhere in the mid sixes. Based on information they've put out there. So we will not be surprised if this year they ratchet down that discount rate again, which will of course drive up the UAL. So what we did was some high level analysis to look at, we think the UAL could come down to 16 or 17 million. But if Calpers does increase or decrease the discount rate, that would go back up to 22.5 million or so. We picked a number right in between there. I will say with a lot of agencies we work with, the goal really is to maximize savings, but at the same time reduce the risk that you'll go overfunded. So this is why a lot of agencies will target kind of that low to mid 90 percentile funding ratio, because if Calpers does have a bunch of good years and you go overfunded, let's say you're above 100% on the funding ratio, you actually don't get the benefit of those gains. Calpers holds on to that. until there's future UAL that you can use to offset it. So that's something that is part of the calculus. Again, we're far away from any sort of recommendation or fine tuning this, but that is the rationale behind the 19 million as opposed to doing the full thing. You do have the option of doing the full amount. I'd say the majority of agencies back off from that full amount just to reduce the risk of going overfunded.
The other part of the calculation in the situation of Oroville is that you have a sizable Section 115 trust amount. And we think of those monies that you've set aside in the 115 trust as a kind of a shock absorber as well, whether you use them in the future for annual payments in a tough revenue year, or you take away a new base, amortization base, a new layer that Calpers may add on. That's at the city's discretion, but it is another factor that is fairly unique for the city of Oroville, because compared to your overall UAL, you have a pretty good chunk of money in that Section 115 right now.
Eric, do you want to talk about this, or you want me to keep going on 15? Keep going. Okay, so in terms of the takeaways, I think we just looked at the savings estimates. As I mentioned before, lots of options on the table as we if we do have time to really tailor those options to the city's needs, also risk reward tolerance. And I think I mentioned before the trade-offs between the shorter and the longer maturities. The shorter maturities do have a slightly lower interest rate. That means and you will save more on the back end, but because your annual payments are higher, that does mean less resiliency to handle future economic shocks, including Calpers underperformance. And conversely, the longer the maturity, slightly higher interest rate, slightly less savings over the long haul, but you do have a lower annual payment, which means you do have increased long-term resiliency. You have more capacity to handle those future shocks. I do want to mention one thing, because Eric brought up a good point, that all the pension bonds, or maybe not all, but 99% of the pension bonds issued between 2000 and 2010, like the city of Oroville's, those did not have the ability to prepay the bonds in a cost-effective manner. All of the pension bonds being done now have what's called a 10-year call at par, which means after 10 years, you can pay these bonds off with no penalty. So that's another reason why some agencies have opted for the longer repayment shape, knowing that if you do want to pay it off early, let's say in 10 years or 15 years, if you've socked away money into different reserves, you can pay it off. So just one thing to note. We're going to get into the risks of the reinvestment and market timing risks and kind of the stress testing process that we often recommend. And we also recommend that a pension funding policy is adopted. This is something that's very common right now for other agencies doing UAL restructurings, because it does provide a roadmap on how kind of some of the savings would get funneled. A lot of our pension clients are, realizing that there might be future UAL down the road. So, taking a portion of the savings from the pension bond and socking it away in that Section 115 trust or other city reserves, whatever your priorities are, but really creating a roadmap for addressing that challenge long term. And we'll get into what a couple sample policies look like. Eric, do you want to take the risks?
Sure. We're going to start the conversation about the risks. I think we've outlined clearly the potential benefits. At the top of the list is sustainability, where you've reshaped the repayment schedule. Near term, certainly there's going to be near-term budgetary savings. Over the long haul, it's dependent upon Calpers returns. You would increase your funding ratio and you have the flexibility to modify the maturity with a pension bond. Now, we like to dwell on the risks a bit. So I think it's been stated, and it's pretty clear, when you give CalPERS an extra chunk of money, that gets exposed to the market. So reinvestment risk and market timing risks are risks, unavoidable. You give them more money. If they have a big downturn like 2008, next year, as an example, that extra amount of money is exposed to that, and that's a risk. The city would be worse off, at least in the near term, and who knows, no one can predict what the long term would be. So that is a risk. And just generally speaking, reinvestment risk, is CalPERS going to earn in a simplistic way over the long haul, over the term of the bond, are they going to earn more than the bond? So, you know, I mean, that is the bottom line, and we're going to talk about it in a couple of different ways on the next several slides. But again, market timing, you know, giving them more money in the near term if they have a big loss, that gets amplified because you gave them more money to lose in a big way. And over the long term, if they don't meet their marks, but if they're below the bond rate, the city would look back at the end of the term and determine that it was worse off by doing the bond. So we like to go into the stress testing a little bit. As Mike mentioned, just a long-term underperformance, say 5%. And also throw the what if of another 2008 recession. Those are examples that are really easy to understand and clarify for decision makers if the reward versus risk is right for your public agency. Next page. So we think it's important to put this slide in here on all of our presentations. The GFOA, Government Finance Officers Association, I think it was 5 or 6 years ago, went on record as being against pension obligation bonds. And they cited 6 primary reasons that we've put here. The lower 5, I'm going to read through these because I want it on the record. The lower 5, I'm going to go through first. Pension bonds are complex instruments that carry considerable risk and may include swaps or derivatives. That's not the case with the last 2 years and even the last 5 years of pension bonds. They're all fixed rate and no swaps or derivatives are being used, at least in the ones that are being issued in California. Next, issuing taxable debt to fund the pension liability increases the jurisdiction's bonded debt burden and potentially uses up debt capacity. That's not true in the sense that the pension debt that you have is on your balance sheet right now. So you're really swapping one debt for another. There is a conversation, it's a very nuanced conversation about soft debt with CalPERS versus hard debt with a bond investor. That's a conversation that we like to lean into and have a conversation about where you're transferring the risks of non-payment and default risk. You transfer them from retirees to bond investors, and what are the remedies to the city for to others against the city for non-payment. Those are all conversations we're glad to have, but at its core, you're swapping one debt for another debt on your balance sheet. Pension bonds are typically issued without call options. As Mike just mentioned, all the deals being done now have a 10-year par call, and that's the standard, and the investors accept that. Pension bonds are frequently structured in a manner that defers the principal payments. There was several of these transactions last year that had a year or two of principal payment holiday. But most of them did not. They started amortizing principal right away, and the reasons that some of them did that was because of the pandemic, and they were concerned about revenues, and they wanted a little bit. It was a way to manage their revenues and expenses. Lastly, rating agencies may not view the proposed issuance of the pension bonds as a credit positive. We've got a direct experience. That's not true. We've spoken with rating agencies. The caveat is that a pension bond is a big undertaking. It's a very complex undertaking. That's why we're here today. So it needs to be prudently structured to create payment affordability and flexibility and enhance resiliency and part of a policy-driven process and strategy. So those are the parts of the GFOA advisory that are no longer true. The one part that we've discussed over and over and over again that is true and is unavoidable is the reinvestment risk and the market timing risk. So it really comes down to, among other things, the risk versus reward calculation by decision makers of whether the borrowing rate is low enough so that you have confidence and comfort that Calpers will, over the long haul, earn more. Next page. Mike?
Sure. I'll take a crack at slide 18 here. What we wanted to do, I want to mention that the stress testing process, it's typically a more formal process with an actuary or depending on the team members. It does take quite a bit of time. What we wanted to do was some quick analysis, though, high level, to show a very dire type of scenario. So what we came up with, and I'll walk through this chart. I know it's a lot of colors going on, but what we wanted to assume was that in the very first year after doing a pension bond, Calpers loses 20% and they don't recover. So instead of earning 7%, they lose 20%. This is roughly about what the impact from 08 was. So in this chart, there's four things going on. The first of which are the light gray bars at the bottom. Those are the same payments that you've seen on previous slides. Those are your current pension payments, your POB and your Calpers UAL. And then right above that, or right in the middle of that, is that orange bold line. That is the same line we showed on a previous page, which would be your payments if you do a 25-year restructuring. And the next two things we layered on are what the impact would be if Calpers were to go out and lose 20%. And so in the gray bars, that would be the impact, the hit to the city if you do not do a pension, if you did not do a UAL restructuring. So you would get hit with about 16 million of new unfunded liability. Those gray bars would get added on. Those dark gray bars would get added on to your light gray. Those would be your new payments. Status quo, no UAL restructuring. If you had done the UAL restructuring, so that the bold orange line, you had more assets exposed with Calpers to this big loss in the first year. So you would get hit with a bigger new unfunded liability. And on the top right there, you can see we estimate that at about 21 million. So that's 5 million more than if you had not done the bond. That eats into the savings. And then we've shown what the new payments would be in the orange dotted line. So big picture, there would still be savings. The city would still be better off. The savings are positive. You can see for the first 14 years, your payments are still lower. Then you'd be a little worse off in the last 8 to 10 years. But most of those savings, I think we estimated about 5.5 million of savings would get wiped away if this scenario were to happen. So again, negative 20% first year, no recovery. This is just an example of what stress testing means. Obviously, the scenarios that we and others could run are up to the council and to staff. So that's something we kind of work through with staff and then turn that over to an actuary or to the financing team to actually do all the modeling of those because it is fairly complex. So I'm going to stop there on 18 and see if, Eric, you want to add anything here or if there's any questions on this chart.
I think one thing to clarify is that, and correct me if I'm wrong, Mike, the assumption is a 20% hit in year one, and then Calpers earns 7% thereafter, so that it's basically that 1 year hit, correct?
That is correct.
Okay.
Yeah, the other scenario we often run with, it's a little more complex to do, but is another 08, because 08 was a little unique. There was a 24% loss, then a 5% loss, but then they had a big rebound of 12 and 14%. So we can really get nuanced with the type of stress testing, but to start, I think this is what we wanted to do. And yes, you're right, Eric. It's 1 year, big crash, and then back to 7% moving forward.
Any questions?
The
May I ask how we doing on time? We want to make sure we're conscious, but we're going to take as long as it needs. Okay.
So the one on slide 19, wanted to throw out a few things that are unique to Oroville. First of which we touched on. City has gone through a validation process. It does have pension bonds outstanding. So that brings up two things. One is we believe a new validation would not be required, although if the city were interested to continue kind of evaluating this strategy, I think the next step would be to get legal counsel to opine on and review those older documents that were done back in 06 and 07. The other the other thing is that if the city were interested to go back and look at how those old pension bonds performed, we have been through that before. I know the city of Riverside, when we did their pension bond last year, they had two sets of pension bonds that they did in 04 and 05. They had their actuary go back and do a report of how those bonds performed, given that they were issued right before the Great Recession. So that was part of their kind of due diligence and better understanding the risks. This obviously, the 07 pension bond, not the greatest timing, given that 08 happened the very next year. So I think it would, based on our initial read, that may be close to a break even. Not exactly sure, but it would be something that an actuary could do if the city were interested in doing that. I don't want to spend too much time on this slide. It is very important, but I think we've hit a lot of this. We think that there's a lot of components that are important to a full evaluation process. The quant side, really diving into different sizes, different shapes, really understanding what the city's goals are, taking feedback from staff and council to really keep refining what those options could look like. We talked about the stress testing process. Both, a couple of reasons. One is to better understand the risk reward, but two, where we have found this helpful is to really use that information to better refine the actual structure of the bond. So sometimes we'll see that one scenario doesn't look as good through the stress testing because perhaps the resiliency isn't as good if there was a dire situation. And those are helpful tools to see as you decide if you were to move into this process, which option could work best. Market timing of investing proceeds, that is something that, there's two parts of the equation. There's where you can borrow at. That's obviously, we're in a very low interest rate environment. There are lots of nuances with when to give that money to Calpers. Don't need to get into all of those nuances on this initial call, but that is something we take into account as we're coming up with perhaps optimizing the timing of when to give that money to Calpers. And then lastly, pension funding policy is something that many of our pension clients have been putting into place. Even for those who don't have a pension bond outstanding or who aren't even going through a UAL restructuring. But this is something that, as we've been through a lot of credit rating processes in the last year or so, historically speaking, some of the policies that cities have are reserve policies, debt management policies, perhaps, forecasting, cybersecurity policies. But one of the policies that they are looking for these days is a pension funding policy, and really the plan behind how the city is going to address that liability over the long term. And that could be with or without any sort of debt. So this graphic here is just a sample from one of our clients who recently did a UAL restructuring, and what they did is just revamped their general fund reserve policy a little bit to include kind of a subcomponent of a pension reserve policy. And what they have are certain percentages of the annual surplus that they think will get created through a UAL restructuring. And then they have that money going to fill up different buckets. So whether it's economic contingency and catastrophic event reserves, their Section 115 trust, capital. This city actually created a new reserve called a POB bond call reserve. Those monies will actually get used in the future to pay down the debt early. So, Eric, I know you want to. This is something that's very important in your mind. If there's anything perhaps I missed on the policy aspect.
Nothing. That's perfect. We
Okay.
think it's a very important component, whether you execute a transaction or not. So 2 pages left. This is the second to last. The liability is the largest debt on the balance sheet, and it's grown significantly. And the payment structure, the repayment structure, is ascending for the next 10 to 12 years as well. In some cities, that is actually crowding out other community priorities, because year over year you have to find money to make that extra payment on the irregular repayment shape. Oroville is a little bit more fortunate, it seems, these days. This is really a high-level discussion to optimize and see if there's a better way to handle that debt. As you're realizing, I think from this conversation, this is a very complex undertaking with a lot of moving parts. The problem, the options, and the risk need to continually be fleshed out so that the decision makers, you, City Council, and stakeholders in the community are understanding the problem, the options, and the risks. Quantitative aspects are very complex, maybe the most complex type of municipal bond transaction, just because of the way you pay off those outstanding Calpers layers. Again, the risks are quantifiable, but the city needs to understand so that it can make the informed decision on the reward versus risk. Given the potential benefits, but now knowing the complexity, it's recommended that this process, continues. That's NHA. We feel strongly that's our job, is to make sure that we look at everyone who is a decision maker, and that everyone is nodding their head, that they understand all of the nuances. We're here and available to answer questions or find the answers if we don't have the answer at that time. That's what we believe our job is. Irregardless of a transaction, though, a pension funding policy for this challenge that is before the city and most every other public agency in the state should be undertaken. We feel strongly about that. Last page. Next steps. I think that was in the agenda. We were looking for direction from City Council, and if there was a direction to move forward, then here are some of the thoughts about continuing the evaluation process with more options, robust options. And if there was direction now or in the future, there's a couple of points in time where council has the opportunity to review legal documents and approve them, review the offering document to investors and approve them. Those are all go, no-go points. So, and with that, we conclude our presentation.
Thank you. Madam Clerk, do we have any comments or questions from the public?
Mr. Mayor, I have not received any public comment cards for this meeting.
Do we have any comment? My question would be to you, Ruth. You are our expert in this area. And, I mean, I know that there's some of us that understand some of it and some of us that understand most of it, but this is your forte. What would be your recommendation?
Well, I think that the reason we're here is because interest rates are low and Calpers interest rates are high, and that's the basic reason why we're here having this discussion. So I think it's just very important that we understand all the risks going in, and understanding the risks would kind of you'd have to know what's in the future, and we don't know what's in the future. We don't know what Calpers is going to do. So I feel like, we're here because interest rates are low. We could take advantage of that. We could realize a lot of savings. I really like the idea of having a pension policy where we took the savings and put them away, because for sure we're going to have future unfunded liabilities. We pay off our PEPRA every year, and every year we get a new one. But we have, by the end of all the things that have been committed to our PARS account, we're going to have $5 million. Like Eric described that as a shock absorber. We could use that to address new unfunded liabilities. We're paying off PEPRA every year. I feel like we have a lot of tools available to us, and I think that council should really consider this. It could be a savings for us.
So you're recommending the bond?
Yes, I'm recommending that we continue. I think the direction is to continue having these workshops so that everything is vetted out. But I think that we're here because it's a good deal.
Okay. Councilmember Pittman?
Yeah, Eric, could you step up to the podium? And I definitely see some strong interest, and I agree with what our finance directors just commented on. What are the legal steps in this process? Did all those cities that you presented, how did they actually approve the bond? The reason I'm asking this question, there seems to be some confusion going on in the city of Chico.
I'm very, very familiar with the confusion in Chico.
So what does it take to approve this process?
As we noted, the fact that you've done a pension bond in 2007, you've gone through the gauntlet, if you will, which is the validation process, where you put forth the notion that you want to refinance the unfunded liability with a bond, and you put that into the courts, and then the court reviews that. It can be challenged, which is what's potentially happening in Chico, or it's not challenged, and then it's validated. The judge puts out a judgment, and then that judgment stands forever for the city of Oroville. We think. We're not lawyers, so we'd have to get that confirmed by a good lawyer, and we know many. Mm-hmm. So, but we haven't run. That's presumptuous of this at this point. We just note that that's a point in your favor. So really, there's no opportunity to drag the city into court. You have a validated judgment, so you're able to, it's all within the city council's ability to give direction, and then every step of the way review and approve legal documents and offering document, give staff direction on the parameters that you would require that a transaction be executed at. Some Some have put like a interest rate cap on things, so.
Well, I appreciate that answer. Given the parameters that this council would set, then essentially it would be the council's approval by a simple majority to move the process forward.
Correct.
Okay. And in Chico, it's complicated because they probably didn't have the validation before.
Correct.
Okay, thank you. That answers the question very well. Thank you.
So, Ruth, were you going to provide us with some actual options, or are we to determine this out of this presentation?
I think the option is to just move forward.
Yeah, it's just direction.
It's just direction to move forward and that you're interested in doing this, and so a lot more information will be brought to you.
Okay, we just want to get it right.
Yeah.
Yeah.
Yeah. Councilmember Smith wishes to speak.
Yeah, another question, Eric. Just, as we all know, this is not unique. As far as unfunded liability, the state is grappling with it. It's billions and billions of dollars.
Right.
So is there any, and given the state's history here, you were giving that one slide, kind of dispelling some of the myths or misunderstandings. So there's already kind of a negative taste within the state. So would it seem anyway. Maybe that's changed. Is there any move that they could make that would make this an issue? There's a surplus like the state has. Is there any kind of moves that they could do that would either make this more favorable or more problematic for cities that have chosen this option? Going into the future, given the complexity of the circumstances on a larger scale.
The state of California,
State of California.
helping with their surpluses, local governments.
Yeah.
I
mean,
think
that's
that's a remote.
I'm sure it is, but it's just a thought. But that would be really generous of them.
It would be, yeah. I wouldn't, but
Yeah.
I've been wrong before, but I wouldn't expect that. I do know that Calpers, and Mike can chime in on this, we've been hearing that Calpers has been taking, there's $6 billion worth of pension bonds that have been done in the last 12 months, and this has been helpful for Calpers as far as managing, getting those funds coming in and managing those, getting an increased funding status. It's still a blip on the overall unfunded status system-wide. This 20% year that they're having could be a good year, but then they might just take it all back by lowering the discount rate. So I'm not an actuary, I'm not a lawyer. We know what we know, and we think we've got everything on paper for y'all to sort of think about. But if you have questions that we can't answer, we'll endeavor to get those answers.
Thank you.
Councilmember Pittman.
Thank you, Mayor. He opened up another question because I understand you're working with local cities, local districts that all have PERS accounts. What is the state of California doing for its employees' unfunded liability?
That's a great question. Mike, you have any reconnaissance on that? Because I believe there's built-in objections at that level.
I don't. I know that I don't believe they've, they're looking at any sort of restructuring. I wouldn't be surprised if they're taking some of that surplus and paying it down or putting it into a 115 trust. But that's something we could follow up with. We could talk to some folks.
It would be an interesting conversation because.
Good for us to know, too.
Well, yeah, it would be. It's just, we all have this UAW problem, and it's interesting to see how they would be handling that. Could the state actually do a POB?
I believe they could, couldn't they? Yeah, I think so. Why wouldn't they be able to? I've heard, other states, state of Illinois, I know big cities have done it, so.
Sure.
We'll have to get back to you on that.
I appreciate that. Thank you.
If there are no other questions, I'm looking for a motion to direct staff to move forward with this.
I'll make the motion that we move forward with this process. And given the presentation today, I like the offerings that were presented and just more detail on those presentations that we saw as numbers that you presented, and bring it back to us.
I'll second that.
Motion carries with 6 yeses and 1 absent.
Okay, with that, we're going to adjourn until Tuesday, June 15th, 2021 at 4 PM. Meeting adjourned.
Thank you all.